India is growing at its slowest pace in a decade. The currency has again hit an all-time low, with increasing concerns that policymakers are losing track. Prime Minister Manmohan Singh reassured that India won't face a repeat of the 1991 economic crisis. But how is the economy holding up? Bhanu Baweja of UBS now joins us on this conversation. Bhanu, many thanks for joining in. A host of measures over the past couple of weeks from the central bank, but nothing seems to be working. What's your own assessment of the latest in control on capital flows? Do you see that working?
What the RBI started with was trying to restrict the deficit by trying to restrict imports. Now, obviously, they try to restrict gold imports through duties, but the issue is that the largest import that India conducts is oil. And oil prices globally have been going up. Volumes of oil imports are actually reasonably sticky. I mean, investment in India is low, which is one of the bigger problems for the economy. And that does mean that volumes come off a little bit, but in fact, oil imports are not very sensitive to the level of GDP growth. The volume stays reasonably flat because remember that, the per capita incomes in these economies have been growing over the last few years. So the trade deficit, just because of gold prices, was unlikely to come off and hasn't come off massively just because of that, right? So that's the first thing they focused on, and increasingly they are moving towards the capital account because really plan A, which was focusing on the current account and bringing it lower very, very quickly, hasn't worked.
Sure.
The current account has been quite inelastic. So the second plan, the plan B, is to move towards the capital account.
Sure.
So these are the first steps of capital controls, and really I don't think it will concern too many investors right now. I don't think too many investors can legitimately say, India is going to completely shut down its capital account. That's not what the RBI intends. But they are on a slippery slope. They are paying the cost for bad policies earlier, and not necessarily bad monetary policy earlier, but bad fiscal policy. India is not in control of its own destiny. So I don't see how these measures are going to attract the kind of capital that India needs on a monthly basis to be able to fill that current account, which still remains fairly wide.
Bhanu, if this is not something that monetary policy can help, what, in your opinion, needs to be done by not block?
Exactly. India's problem is not monetary policy, and the RBI has done the right thing, in my humble opinion, by trying to tighten liquidity right now, which many people disagree with. But I think you really have to take the longer term view. If inflation expectations do rise, then it's very difficult to bring them back down, and that hurts savings and investment much more in the medium term. So I realize that many people are saying today that if you push rates high, it's going to hurt the equity markets. But equity markets is not the only thing that the RBI has to consider. They have to consider long-term investment, long-term savings, and inflation expectations. The issue, as you rightly say, rests with the North Bloc. And the stuff that they can do, unfortunately, is not going to give you immediate gratification. We have to put this in context. We have to recognize that the problems that the Indian economy is facing today, which are only manifest in the capital markets, in the rupee, have been around for some time and have been some time coming. It was in 2006 when wages began rising very, very aggressively, when inflation expectations began rising quite aggressively, and people moved away from deposits towards gold. So they moved away from financial savings towards physical savings, sure. which in macro terms basically means lower savings, because
right.
in from a macro perspective, the consumption of gold is really just that. It is consumption. It is not investment, even if it may be so from an individual perspective. So we are paying the price for bad policies over a significant length of time, right? It is very high expenditure, and expenditure on current activities as opposed to capital expenditure from the North Bloc. Now, they are trying to change that at the margin, but I think it's going to take a long time for them to make sure that growth in wages is in line with growth in the economy, that the fiscal deficit, the primary deficit, is actually much, much lower. In fact, I think the risk this year is that the primary and fiscal deficits are higher than what the finance minister is saying, because, again, growth is going to be weaker, so you're going to suffer on the revenue side.